Tax treatment of retirement plans, pensions, and annuities. Welcome to this discussion of tax treatment of retirement plans, pensions, and annuities. This course will examine qualified employee plans, their limits, and their tax treatment, along with a discussion of annuities and their taxation. Before we begin that discussion, however, let's briefly look at the important provisions of recent legislation affecting retirement plans. The Secure Act introduced a permitted retirement plan distribution of up to $5,000 within 1 year following a qualified birth or adoption, irrespective of the participant's age, without incurring a 10% premature distribution penalty tax. Although the distribution is taxable, it may be repaid, and the repayment will be considered, for tax purposes, to be a trustee-to-trustee rollover. The Secure Act changed the age at which required minimum distributions must begin from age 70 and a half to age 72. In addition, it changed the distribution requirement for beneficiaries following the death of a plan participant before age 72. Under the revised distribution rules, a beneficiary other than a spouse, a beneficiary who is disabled and chronically ill, or a beneficiary not more than 10 years younger than the descendant, must take a distribution under the 10-year rule, requiring the beneficiary's entire interest to be distributed by the end of the 10th year following the participant's death. Qualified retirement plans may now be adopted up to the due date of the employer's tax return. Small businesses establishing a retirement plan may receive an increased tax credit of up to $5,000 for the ordinary and necessary costs of starting a plan. Because automatic enrollment increases retirement plan participation, small businesses that incorporate an automatic enrollment provision in their 401k plan may receive a credit of $500. Historically, employers have been permitted to exclude employees from their 401k plan who have not worked at least 1,000 hours in a single plan year. Although collectively bargained plans are exempt, beginning in 2021, employees who have worked at least 500 hours in 3 consecutive years must be included. When you have completed this course, you should be able to distinguish between the types of qualified employee plans, recognize the limits imposed on qualified employee plan contributions and benefits, list the requirements applicable to qualified employee plan loans, apply the federal tax laws to qualified employee plan contributions and distributions, recognize the tax treatment of non-qualified annuity distributions, and identify the tax treatment of annuity contributions and distributions. The term qualified retirement plan generally encompasses a range of plans including pension plans and profit-sharing plans that meet specific Internal Revenue Code requirements. A qualified retirement plan can be couched in terms of the contribution to be made to it or in terms of the benefit to be received at retirement or at some other time. In the first case, the plan is a defined contribution plan. In the second, it is a defined benefit plan. As we'll discuss, this seemingly simple distinction makes an enormous difference. We'll take a very brief look at the basics of these plans, and we'll begin by looking at defined benefit plans. A qualified retirement plan designed to provide participants with a definite benefit at retirement, a plan usually referred to as a traditional pension plan, is known as a defined benefit plan. The benefits that are provided by the plan determine the contributions the employer must make to it. To illustrate, and without considering the effects of plan earnings, if an employer has to accumulate $100,000 to fund a particular participant's income benefit at age 65, and the participant enters the plan at age 55, the employer has only 10 years to fund the benefit. The employer must contribute $10,000 each year to the plan. However, if the same participant entered the plan at age 45, thereby giving the employer 20 years to accumulate the needed funds, the employer's annual contribution is cut in half. This is the reason defined benefit plans generally favor older plan participants. Plan earnings or losses will affect the amount that the employer is required to contribute to the plan each year. Because of that plan design, the length of the participant's accumulation period before he or she retires has a very significant effect on the size of the required employer contribution. Clearly, the shorter that the accumulation period is, the larger that the contribution must generally be. Thus, a defined benefit plan's contributions are disproportionately higher for older employees than for younger employees. Contributions to defined benefit plans are required each year. Except for changes in the covered participants, the contribution changes are based principally on how well or how poorly plan assets perform and whether or not their performance meets the growth assumptions underlying the annual actuarial calculation. Thus, the employer assumes the investment risk in a defined benefit plan, and all contributions are generally made by the employer. The employer must adequately fund the plan, despite the plan's investment experience. As a result, if the investment experience is good, the required employer contributions may decline. If it is bad, they will probably increase. Benefits under defined benefit plans are usually stated in terms of a percentage of the participant's final compensation. A defined benefit plan's assets are pooled, and no individual participant accounts are established. Although defined benefit plans are normally funded solely by the employer, a defined benefit 401k hybrid plan authorized for years after 2009 is an exception to that general funding rule. Under a defined benefit 401k hybrid plan, the sponsoring employer guarantees the benefit at retirement under the defined benefit portion of the plan. In addition to the defined benefit, however, the plan participant may increase his or her retirement savings through elective deferrals made to the 401k part of the plan. Under current law, eligibility to sponsor a defined benefit 401k plan is limited to employers with at least 2 employees, but no more than 500 employees, provided the plan meets certain benefit and contribution requirements. The defined benefit part of the plan must provide a retirement benefit of at least A. 1% of plan participants' final average compensation multiplied by years of service, or B. 20% of final average compensation. Under the 401k portion of the plan must provide for an automatic employer matching contribution arrangement of 4% of participant compensation. It is no secret that defined benefit plans tend to be fairly complicated and somewhat more expensive to administer than many other qualified employee plans. In contrast, defined contribution plans are generally simpler than defined benefit plans. In the case of defined contribution plans, no actuarial calculations are usually required to determine contributions, and no stated benefit is provided by the plan. Instead of a stated benefit that the employer must provide, the situation defined benefit plan sponsors face, a defined contribution plan is couched in terms of the employer's contribution. The benefit provided to the participant is simply based on the amount accumulated at the time it is taken. Common qualified plans falling into the category of defined contribution plans are 1. Money purchase pension plans, 2. Target benefit plans, 3. Profit sharing plans, 4. 401k plans, 5. 403b tax sheltered annuity plans, 6. Simplified employee pensions, also known as SEPs, and 7. Savings incentive match plans for employees, also known as SIMPLES. Since the benefit at retirement in a defined contribution plan depends principally on the performance of the plan assets, the participant, rather than the employer, assumes all investment risk. It was noted earlier that defined benefit plans involve pooled plan assets. In contrast, individual accounts are the defining feature of defined contribution plans, and such an account is established for each participant. One of the benefits of individual account creation is that participants generally have a better understanding and appreciation of the plan. Because of the nature and complexity of a defined benefit plan, the retirement benefit is often a complete mystery for the majority of participants until just prior to their retirement. Furthermore, contributions are also easily understood by the defined contribution plan participants. They are typically stated as a fixed dollar amount or fixed percentage of employee compensation and, except in the case of discretionary contributions, must be made at the same level each year. Since younger participants at the time the defined contribution plan begins generally have a longer period of time until retirement, Compounding can make a substantial difference in the amount accumulated at retirement for them, in contrast to a defined benefit plan whose design favors older participants. The benefits at retirement in a defined contribution plan generally are greater for participants who begin participation when they are younger. Let's check your understanding of the material just covered.